Welcome to the Retirement Made Easy podcast, a show created to be your go-to source for straightforward retirement advice. Best of all, it is presented in a language that you can understand. Are you ready for some straight talk on retirement planning without all the fluff? Well, you found the right podcast. Here's your host, certified financial planner, Greg Gonzalez.
Hey, welcome to another episode of the Retirement Made Easy podcast. I'm Greg Gonzalez. Thanks for joining me today. A lot of people ask where I come up with the content, the topics to talk about on this podcast, and it's really quite easy, especially when you own a retirement planning firm. You're talking with people literally every single day about retirement planning issues and topics and concerns that they have, and then you just use those questions and topics and share them with the listener audience that we have on the Retirement Made Easy podcast. And then the second source of topics of discussion comes from you, the listeners, which go to our website, retirementmadeeasypodcast.com. A lot of people submit their questions that way, or they email me, hey, you haven't talked about this. I want to hear about this other topic. That always helps me a bunch. Lately, I've been getting a lot of questions. I don't know what it is, what's in the air, but the last couple of weeks from prospective clients, listeners of the podcast, current clients about taking loans from their retirement savings, whether that's an IRA, Roth IRA, 401k, 403b plan, whatever it is. A lot of questions been coming in about that and how you go about taking those loans or withdrawals, and then how you pay them back. And I know a lot of listeners might be thinking, ooh, you don't want to do that. Well, I always tell my clients, prospective clients, I am a financial planner. My job is to give you the information so you can make informed decisions, so my clients can make informed decisions. You are the financial deciders. You, at the end of the day, make the decision to do something or not to do something based on the advice that I provide and the guidance that I deliver. And I think once people have like a full picture of how like a 401k loan works, then we can make a better, more informed decision, because you got to understand kind of the nuances and all the details behind this decision and taking an action like taking a loan out on a 401k versus just, your advisor who you trust and you depend on saying, no, you don't want to do that. Don't do it. That's really no help at all because it's not helping you understand anything. They're not being a good teacher. So that's what we're going to talk about on today's episode is accessing those retirement savings and taking loans from them if you need the money or you want to help your kids out, whatever the case may be. And that'll be the main focus of today's episode. If you're a new listener, I want you to check out our website, retirementmadeeasypodcast.com. There's resources there you can download. We're working on some more, and we will be uploading those here very shortly. We have the outlook, the mid-year outlook for 2024 for the second half of the year. That's literally just got released this week as I'm recording this episode. So if you're a client, send me an email. I'd be happy to send that to you. If you're a listener, right there at retirementmadeeasypodcast.com, say, hey, I want a copy of that mid-year outlook for 2024. I'd be happy to email that to you. And for those people that are looking at hiring a financial advisor to help them with retirement planning, there's a section on our website where you can click on Work with Greg and reach out to us that way. Let's jump into today's topic, which is taking loans out or dipping into your retirement savings should you need it. So like I said at the start of this episode, just probably 4 or 5 different people were asking questions, both podcast listeners, clients, prospective clients, asking about loans on retirement savings or retirement accounts in general. So be that an IRA, Roth IRA, 401k, 403b, just across the board, I had people asking about how they dip in to take a loan, what the costs would be, the penalties, all that kind of stuff. So we're going to talk about that on today's episode. First off, 401k loans. You may work with people. It always seems like clients always say, well, I got this guy at work or this lady at work. She said she's doing this. Is this something I should consider? Because I guess people talk naturally. You get into conversations with people and they want to share their business with you. And you get to thinking like, gosh, sounds like a good idea, or maybe that sounds like a terrible idea. So first off, as we have talked about countless times on this podcast, not all 401ks are the same. The plan summary document of your 401k will tell you whether 401k loans are allowed or not allowed. For example, our 401k in my small company, we do not allow 401k loans. It's in the plan provisions of the plan summary document. If you have questions, of course, you can call the custodian, the provider of your 401k, and ask, hey, call the 800 number on your 401k statement. Are loans allowed? Are they even allowed for our specific 401k through the company? Generally speaking, and again, I'm really, really generalizing here, but generally speaking, the bigger the company, the higher the likelihood that they allow 401k loans. And that has been my experience in my career looking into this. Again, your specific plan may be different. You may work for a big company that doesn't allow 401k loans, so you want to check to make sure. The next thing is you have to be an active employee of the company to be able to get a 401k loan. You can't go back to an old 401k for a company that you used to work at and say, hey, I want a loan on the 401k. So that's one of the rules or provisions. In getting a loan, you've got to be an active employee. And there are limits to the loan. So if you've got $500,000 in your company 401k, you can't say, all right, I want to take a loan out of $400,000. They're not going to allow that. So typically it's a limit that you can borrow is the lesser of $50,000 or 50% of your vested account balance, whichever is less. And there's one exception. If 50% of your vested balance is less than $10,000, the participant can borrow up to $10,000. So I think this bit of knowledge surprises people like altogether. They think they're going to be able to take out like hundreds of thousands of dollars out of their 401k as a loan and then pay it back. And for some people, that's a wake-up call. Like, hey, the most you're going to get out of this thing's $50,000. And then you're going to pay that back plus interest into the account through payroll. It's all taken care of through payroll, right? Payroll payments. You are essentially paying yourself back. And there may be some people out there saying, wow, this sounds like a great deal. Well, again, we need to explore this a little further. What are the risks of doing this? And as a financial planner, I look at things differently than the average person. The average person probably just they skim the surface. They're kind of just looking kind of ballpark. How does this work? Well, it's kind of like if we had an MRI done and a radiologist is looking for those tiny, minute fractures, those hairline fractures that the naked eye would barely see. You and I, as just average people, that radiologist is trained to see certain things in x-rays and MRIs that the average person would just not be able to detect at all. So if I'm looking at a 401k statement, that's one of the things that I look at first is, okay, is there a loan balance here? Is there a 401k loan balance here that somebody's paying back? I also see the vested amount. Is somebody totally vested in that 401k? Because if somebody wants to retire, like over the short term in the next 6 months, but they've got $50,000 loan on their 401k, but the 401k balance is $450,000, well, guess what? It's not $450,000 because that loan has to be paid back. So this person really has $400,000. And this is the big risk here that we see, especially when the economy goes south and you have all these people that have taken 401k loans that are outstanding. If you are separated from service, what I mean by that is if you're laid off, if you leave and get a new job, whatever happens, you're no longer working for the employer in which you have a loan out on your 401k, you have 90 days to pay back that 401k loan. And if you don't, it becomes a taxable distribution. You're taxed on that entire loan balance. And if you're under 59.5, you have a 10% penalty on that money. And how are you going to pay that off? Let's say you get laid off and you've got $45,000 loan on that 401k, and let's say you can't find a job for 90 days, so then that entire $45,000 would be taxed at the end of the 90 days because you got to get that paid back, and then a 10% penalty, assuming you're under 59 and a half. So $4,500 penalty. And so when you look back in history, just in the economy, just the last 10, 20 years, in these times where literally millions of people are being laid off, it's something that I think of as a financial planner, like, gosh, I wonder how many of those people have loan balances on their 401ks. And then that 90-day clock starts ticking that they got to get that paid off or they're going to be in trouble. So in the past, in helping people make better financial decisions, sometimes if they're lucky enough to get a severance package, you can use part of that severance money to pay back the 401k loan. Now, what's really interesting is once you take 401k loans and get in a habit of doing so, chances are, and I don't have the statistics or the studies in front of me, but in my experience, in my opinion, once you have taken a 401k loan in your life, the chances are higher that habit will continue again and again and again. And for those people, if they change jobs, a lot of times I think it is wise to roll that old 401k into the new 401k where they can take another loan perhaps in the future. Instead of putting it into an IRA, rolling it over into an IRA, because IRAs don't allow you to take loans. So if you rolled an old 401k into a rollover IRA, guess what? The only thing you could possibly do is once a year, they allow you a 60-day withdrawal where you can withdraw from your IRA and pay it back within 60 days, and it's not taxed. But if you don't pay it back within 60 days, guess what? The whole amount that you took as a distribution is taxable. If you're under 59 and a half, you would have a 10% early withdrawal penalty. So that's something to be aware of. The rules with IRAs are much, much different than 401ks or even Roth IRAs, which we'll get into in a moment. And believe me, over the years, I've had people call up and say, hey, I need to take a loan out on my IRA. And unfortunately, they are misinformed because you can't do that. So, however, with Roth IRAs, you can access the money. So a couple things that we'll look up, and I'll put this in the show notes, but it will explain the 5-year rule when it comes to Roth IRAs. Check out the show notes. It'll explain the 5-year Roth IRA rule in more detail. And the 5-year rule is something very specific to Roth IRAs. It doesn't apply to any other account that's not Roth. So the 5-year rule simply says that if you contribute to a Roth IRA, you've got to wait 5 years before you can withdraw earnings tax-free. Now, to help you out, it's January 1st of the tax year in which your first contribution hits. So hypothetically, if you waited until December 31st or let's say 30th, because the company's open, Roth IRA custodian's open on the 30th, you could contribute to your Roth IRA, and then it would only be a 4-year wait because it does revert back to January 1st of the tax year in which that first contribution hits the Roth IRA. And that starts the clock. So even if you put in contributions later on to the Roth IRA, you've started that clock with that initial contribution. Now, I know we're getting into the weeds too much, but Roth conversions, they have their own 5-year clock. Each Roth conversion has its own 5-year clock. Okay, so what we wanted to talk about was dipping into the Roth IRA. You can't take a loan on the Roth IRA necessarily, but you can dip into your contributions, your total contributions at any time, at any age, without penalties or taxes. So this is very important. This is one of the big advantages of Roth IRAs. And that's one of the big things as a financial planner can keep track of and tally for you. Hey, what are your total contributions to your Roth IRA that if you needed to dip into, you could access that money tax-free, penalty-free. But again, this is not a loan. This is a distribution. And that's another thing that I wanted to mention is, of course, 401ks and traditional IRAs, you can take distributions at any time. Now, if you're under 59 and a half, you would have a 10% early withdrawal penalty. There are some exceptions to that. But with all of those dollars being pre-tax or tax deferred, well, guess what? You're going to pay taxes, ordinary income taxes, on that distribution. And that's totally different than a loan from your 401k. And I think really that's the big advantage for those people that want to take a 401k loan is they're not going to get hit with income taxes on that loan. And here's the other thing that I'll mention is for a lot of people, and being a retirement planner, the more options you have, the better decisions you can make. When you're in a corner and you have very, very few options, that's where you're going to get into trouble. And that's my experience. So let me give you a few other options that you can do instead of a 401k loan. Let's say a 401k loan is not available to you. Where can you turn? Well, we have talked about the 3 types of accounts on this podcast that we like to have in retirement. That was episode number 118. And that was a very, very popular episode. So we'll put that in the show notes. You can listen to that. And it basically describes the pre-tax, the Roth, and then the after-tax, the non-qualified account, which is some people call a brokerage account. So if you do have a brokerage account that you can utilize, you might have capital gains taxes that you would be faced with. But hey, maybe instead of a 401k loan or withdrawal or IRA distribution, maybe you could dip into that brokerage account without taking some kind of loan. The other thing is, and we see this occasionally, some people will have these whole life policies that have a big, big cash value. For example, I met with a gentleman this past week and his cash value was $47,000. His death benefit on his whole life was $100,000. Well, he could do a couple things with that. He could take a loan out on his own money. And I know that sounds crazy, but with whole life policies, you could take a loan out on your $47,000 and then pay interest back to the insurance company. But it's a way that you can get a tax-free withdrawal of your own money. The same 59.5 rule would apply. So if you did cash that whole life policy out, you would be faced with gains. You would pay on all the gains of that cash value, you would pay taxes as ordinary income. And then you would have a 10% since you're under 59.5, you'd have a penalty, 10%. So if you would happen to have a whole life policy with cash value, that might be a better option for you. Now, as a Ramsey SmartVestor Pro, of course, I'm not a huge fan of whole life policies, but I run into a lot of people that maybe their parents bought these whole life policies back in the 80s or 90s or whatever the case is, and they may have just kept them for all these years. And then another thing that typically people will do instead of a 401k loan or retirement savings distribution is they will do a home equity loan. Now, this is an incredibly popular alternative, so much so that JP Morgan came out with a study that said for the people that had mortgage balances after COVID, 1/3 of the mortgage holders in the United States took out a home equity loan. Now, what did they do to that money? Well, they tapped into their home equity. So, right, they're buying RVs, they're buying boats, they're doing home improvement projects, putting on a deck, whatever it is. And that really, really stimulated the economy because people were basically tapping into the equity and then deploying that capital, buying cars, buying boats, home improvements, going to Lowe's, Home Depot, whatever it is, they're spending money. And that was great for the economy, but that money's run dry. Very, very few people are refinancing, taking out these cash out refinances because interest rates are so much higher than right after COVID started. But still, it is an option, and you can explore a home equity loan if you really, really needed to, instead of a 401k loan or retirement savings distribution. So my goal for today's discussion was to kind of walk through or talk through the different options that people have, the different considerations. Hey, you could do this, but you might have consequences or ramifications, but you might consider this other option. And so you just need to really explore all your options here But putting my financial planner hat back on, because I've dealt with situations, of course, and helped clients make good financial choices. A lot of times, what I'm thinking is, how is this decision today, whether it's taking a loan out on a 401k, an IRA distribution, home equity loan, whatever it is, what is this going to do to your retirement goal? If you had a goal of retiring at 62 and you want to take this 401k loan, what is that going to do? It's going to push your goal back. And how far will it push your goal back? So because you decided to do this, now we update your retirement plan, and maybe you can't retire until 66 or 67. So there's a cause and effect. So because I want to do this and I have the short-term goal of this, that delays accomplishing my long-term goal of retirement. And so with that in mind, okay, if I do this, if I take this 401k loan or this home equity loan, now I've got to push my retirement back 3 or 4 years or 5 years. That is much, much more impactful in my experience when you put it like that to somebody. Like, hey, because you want to do this, now you're not going to be able to retire when you wanted to, or you had originally planned. Now it's going to be pushed back to this other date. Are you okay with that? Can you live with that? Because that's the real issue here. And just in my experience, believe me, as a financial planner for all these years, I have seen people that have blown up their retirement plan. And a lot of times it's due to early distributions or taking 401k loans and home equity loans. And I've had conversations with people that informing them, hey, because you took this pre-59.5 distribution from your 401k, now you're not going to be able to contribute to it for 6 months. So you're losing out on all those contributions for 6 months, plus the match dollars. So now we've delayed your saving for retirement, and it's costing you all that match money from your employer. So does that help with your decision? What does it really cost you here? And there's a lot of people, you'll talk to probably some coworkers that they say, hey, 401k loans are marvelous. They're there if we need them. There's no prepayment penalties. So the point of this episode was not to try to convince you of doing it one way or another, but really to just inform you and educate you that, hey, you have options. There are consequences to certain decisions and some of these tactics of getting money out of your retirement or out of your home for that matter. And my best advice is always weigh your different options and don't make quick decisions with something that can really have severe consequences to your overall retirement goals. Take your time. Hey, I hope this episode has been helpful. If you have questions, visit my website, retirementmadeeasypodcast.com. I'll see you next time. And remember, always dream big. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, please consult your attorney, tax advisor, or financial advisor prior to investing. This is a hypothetical example and is not representative of any specific investment. Your results may vary. All performance referenced is historical and is no guarantee of future results. All indices mentioned are unmanaged and may not be invested into directly. The SmartVestor program is a directory of investment professionals. Neither Dave Ramsey nor SmartVestor are affiliates of St. Louis Retirement Advisors or LPL Financial. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC. And here's another minute of disclosures from our compliance department. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from the Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, You must do so before converting to a Roth IRA. And as I have said on countless episodes, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor.
Thank you for listening to the show today. Check us out at our website, retirementmadeeasypodcast.com. And if you want some help from Greg, submit your questions at the bottom of the page or sign up for a 30-minute retirement coaching session with Greg. We'll see you next week.